Hey, I'm Todd Walcott, a certified reverse mortgage professional with Contempo Lending here in Palm Springs, California. And today's module is on the Life Expectancy Set Aside, or LESA. LESAs aren't a great thing. It means that you either don't have the residual income needed to qualify for the loan, or you've got some credit problems, or you failed to make all of the tax, insurance, and HOA payments on time for the last 24 months. If any of these events have occurred, you're potentially facing a LESA. The set-aside is a sum of funds held back from the credit line to ensure that taxes and insurance get paid on time. If we have a credit event like a bankruptcy, mortgage lates, or the non-payment of taxes, insurance, or HOAs, then we're looking at a fully funded LESA. The last time I faced this, the non-borrowing spouse was 51 and the property taxes were $7,500 a year. So we were looking at having to hold back $120,000 from the loan proceeds as the set-aside. I'm not sure how we did it, but we wrote a great letter addressing the change of the debit card that caused the late pay on the HOA dues. And in that case, the borrower also failed to make the supplemental property taxes payments for 2 years on time. I think the underwriter gave me a Hail Mary on that one, and we were able to avoid the LESA, which was just going to kill the deal. If you're short on the residual income, which is how many dollars you have left over at the end of the month, then we're looking at the requirement for a partial LESA, which is going to be a significantly smaller amount than a fully funded LESA, but it's still a number. I run into partially funded LESAs on borrowers in their 80s that are relying solely on their Social Security income because they've exhausted their retirement assets. And that's how we can sometimes just fall short on the residual income. The good news is that my 80-year-old borrowers are qualifying for loan amounts in the 60 and 75% range of the appraised value, so these are a little easier to swallow. In both the case of a fully funded or partially funded LESA, there may not be enough money to pay the taxes and insurance from the set-aside for the life of the borrower. We're just working on our best guess for how long you're going to live, and it's just a guess. So these set-aside funds could eventually run out, and then we could run into a problem of the borrower not being able to afford the property charges if we had a residual income shortfall to begin with. If we can document that there were extenuating circumstances like loss of income, death of a spouse, illness, then we can typically work through the issue and get the LESA requirement waived. LESAs always aren't a deal breaker. There are ways to work through the issues causing them with an explanation letter or documentation, but it could cause a delay, and it's something we need to address in the beginning. If you have other questions on LESAs or any other topic, feel free to give me a call. I'd love to talk.